Why has the cost of a college degree exploded by 200% since 1980 while your salary has barely moved? You followed the rules, you took the loans, you got the grades, and you entered the workforce. Yet, you are part of the first generation in American history destined to be poorer than your parents. They tell you it's inflation. They tell you it's the price of success. But what if it's neither? What if the entire student loan system is actually a mathematically perfect wealth transfer mechanism, a modern-day Ponzi scheme designed to keep you renting forever? To understand how this trap was set, we have to look back at a time when the system actually worked. To see how far we've fallen, we have to look at where we started. Let's rewind to 1970. At this point in American history, the concept of crippling student debt didn't exist. It wasn't just rare, it was logically impossible. Back then, the average annual tuition at a public university was roughly $400. Even adjusted for inflation, that's about $3,000 today. If you wanted to attend a prestigious private school like Yale, it would cost you around $2,050 a year. But here is the crucial metric that explains why your parents or grandparents seem so disconnected from your reality: the ratio of wages to tuition. In 1975, a student working a minimum wage summer job part-time could literally pay for an entire year of college and still have money left over for books and beer. A degree wasn't a financial life sentence, it was a transaction. You paid a small fee, you got a skill, and you entered the middle class debt-free. Why was it this cheap? Because the government viewed education as a public good, not a financial product. State governments subsidized nearly 70–80% of the cost of public college. The logic was simple. If the state invests in you, you get a better job, you pay more taxes, and the economy grows. It was a symbiotic relationship where everyone won. The universities weren't obsessed with administrative bloat, luxury dorms, or massive marketing budgets. Their only job was to educate citizens. For decades, this system worked. It built the strongest middle class the world had ever seen. It allowed a 22-year-old to graduate with zero debt, buy a home by 25, and start a family by 27. But you aren't living in that world. You are living in the wreckage of it. Because this paradise wasn't lost by accident. It didn't just get expensive due to natural inflation or market forces. That is the lie they tell you to keep you paying. The truth is, this golden age was systematically dismantled. It was murdered by a change in philosophy, and specifically by a single shift in legislation that turned students from citizens into cash cows. So what happened? How did we go from affordable education to a trillion-dollar crisis? The glitch began when the government tried to help by guaranteeing student loans. It sounds noble, but economically it was catastrophic. In a normal market, a bank assesses risk. If you are 18, have no income, and want $100,000 to study underwater basket weaving, a bank should say no. It's a bad investment. But once the federal government stepped in and said, "Don't worry, if the kid doesn't pay, we will," the logic of the market evaporated. Suddenly, banks opened the floodgates. They had zero risk. And this triggered a phenomenon known as the Bennett Hypothesis. Named after Secretary of Education William Bennett in 1987, the theory states that for every dollar of aid the government provides, universities will simply raise tuition by that exact amount. And that is exactly what happened. Colleges realized they had a customer base with a blank check signed by Uncle Sam. They didn't need to compete on price anymore. They could build lazy rivers, luxury gyms, and hire armies of administrators because they knew you could just borrow more to pay for it. Between 1980 and 2020, while the price of consumer goods rose by roughly 120%, the cost of college tuition skyrocketed by nearly 100–200%. That isn't inflation. That is price gouging funded by your future labor. But a Ponzi scheme collapses if the investors can leave. So the system had to make sure you could never escape. This brings us to the smoking gun. The Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. This is the moment the door locked behind you. Before this era, student loans were treated like other consumer debt. If your life fell apart, you could declare bankruptcy and start over, but specifically for student loans, The lobbyists for big banks and loan servicers pushed a new rule: student debt is non-dischargeable. Think about the insanity of that. You can declare bankruptcy on credit card debt. You can declare bankruptcy on a failed business. You can even declare bankruptcy on gambling losses in a casino, but you cannot bankrupt your way out of a student loan. This turned the student from a borrower into a modernized indentured servant. The lenders have supreme creditor status. They can garnish your wages, seize your tax refunds, and even come after your Social Security checks when you retire. This is where the Ponzi comparison becomes literal. In a Ponzi scheme, the system relies on a constant influx of new money to keep the structure afloat. In the U.S. economy, the new money is the incoming freshman class. These 18-year-olds are funneling billions into the university system, which is then securitized into slabs, student loan asset-backed securities. Wall Street bundles your debt and trades it, just like they did with mortgages in 2008. The system needs you to be in debt. If tuition went down, or if you paid it off quickly, the securities would lose value. The glitch is that the system is designed to maximize the duration of your payment, not your education. You aren't a student, you are an asset class, and the yield on that asset is your life. But here is the terrifying part. High interest rates and corrupt laws are just the math. The real trap isn't in the numbers, it's in your head. If the laws are the cage, then interest capitalization is the lock. Most people assume debt works like a car loan. You pay money, the balance goes down, and eventually you are free. But student loans are designed with a mechanism that defies basic intuition. It's called negative amortization. Imagine you are on a treadmill. You are running at 10 miles per hour, working hard, making sacrifices, sending in your monthly payments, but the machine is set to 11 miles per hour. No matter how fast you run, you are slowly moving backward. This is the reality for millions of Americans. You might pay $300 a month, but your interest accrues at $400. You aren't paying off the loan, you're paying a subscription fee to keep the collectors away while the principal balance actually grows. We see horror stories of people who borrowed $80,000, paid $40,000 over 10 years, and now owe $120,000. In any other industry, this would be called usury or a scam. In higher education, it's called standard repayment. Psychologically, this creates a state of learned helplessness. The system gaslights you. Society told you that this degree was the golden ticket to the middle class. So when the ticket doesn't pay off, you don't blame the system, you blame yourself. You think, maybe I just need a better degree. This drives the credential inflation loop. A bachelor's degree today is worth what a high school diploma was worth in 1980. So, to stand out, you go back for a master's. You take on more debt, doubling down on a losing bet, driven by the sunk cost fallacy. The result is a generation in a state of arrested development. You don't start a business because you can't take the risk. You don't buy a home because your debt-to-income ratio is destroyed. You delay marriage. You delay children. The economy suffers because you aren't a consumer anymore. You are simply a funnel passing your paycheck directly to a loan servicer. You are running on that treadmill until you collapse, all to pay for a piece of paper that barely opens doors anymore. So, is this just bad luck, or is it a perfect crime? The answer might make you want to tear up your degree. So, is the student loan system a Ponzi scheme? In a traditional Ponzi scheme, the operator takes money from new investors to pay off old ones, promising returns that don't exist until the whole thing collapses. In the American education system, the government guarantees money from new students to pay the inflated salaries of the university complex, promising a middle-class life that no longer exists. The only difference? Charles Ponzi went to prison. The architects of this system went to Congress and Wall Street. The bitter truth is that the system isn't broken. It is working exactly as it was designed to. It was designed to prioritize the financial health of lenders and institutions over the financial health of the students they claim to serve. We have moved from a society that viewed education as an investment in the future to a society that views education as a way to extract wealth from the youth. The diploma on your wall is no longer a golden ticket. It is a receipt A receipt for a transaction where you took all the risk and they took all the profit. We aren't telling you to never go to college. We are telling you to stop treating it like a moral obligation and start treating it like a business decision. Calculate the ROI. Because if you don't look out for your own wallet, this system certainly won't. So I have to ask you, looking at the math and the reality of the job market today, is a college degree still an investment? Or is it the biggest scam of our lifetime? Let me know your verdict in the comments below. And if you want to understand why you feel guilty for not working 24/7 to pay off this debt, watch this video on toxic productivity next.